And thank you, everybody, for joining today's Retirement Genius Masterclass webinar session, talking about long-term care life settlements and the history of long-term care life settlements and all that's been done over the years to use this financial transaction as a way to help people pay for long-term care support and services at the time that care is needed. Retirement Genius is an information and resource platform to help families achieve a well-balanced retirement. We focus on financial information, health and long-term care information, and lifestyle information, informing people, educating people, and then guiding them to resources to help them build the well-balanced retirement that they want and everybody deserves. So, to start off the conversation about long-term care life settlements, let's just define what is a life settlement. And it is the sale of a life insurance policy. Remember, life insurance policies are legally recognized as assets. They're owned by the policy owner. In fact, they're recognized in the same asset class as a home would be. So the owner of a life insurance policy that no longer wants to keep that policy has the legal right to sell it for its present day fair market value. So selling a life insurance policy through a life settlement, you're going to get more than cash surrender value, but less than the total death benefit. Investors will then take over the life insurance policy ownership, pay premiums, and the policy owner is no longer responsible for any premium payments towards that policy. They've received the market value of their asset, which on average can be as 5 times greater than cash surrender value in terms of industry averages. Why would people do a life settlement? Why do people abandon life insurance policies? Well, for a lot of people, they either can no longer afford the premium payments. We see that a lot, particularly with seniors who've had policies for a long time, and now they're starting to struggle with priorities. They've got to make choices about how they're going to pay for their retirement and the growing impact of health and long-term care costs. And the premiums on a life insurance policy no longer become sustainable. Or they've just outlived the insurable interest on the policy. They just no longer need it or want the policy. They can look at it as an asset that can help them pay for retirement costs. Getting that fair market value can be a substantial amount of money, tens of thousands, if not hundreds of thousands of dollars. It can be used as a tool to pay for long-term care expenses. And for a lot of people, they look at a life insurance policy as an asset they need to get rid of as part of a Medicaid spend down. Don't forget, life insurance policies are unqualified assets when somebody is doing Medicaid planning, and will often be advised that they should get rid of their life insurance policy instead of keeping it, because it will then be an asset that can count against them for Medicaid eligibility. So we've got some critical challenges facing this country when it comes to long-term care. There's been a growing long-term care funding crisis in this country for years. And start to think about some of these statistics. Baby boomers start turning 80 in 2025. It wasn't long ago we were talking about the first baby boomers turning 65. Now that same cohort, those first baby boomers that started turning 65, are about to start turning 80 in another less than 3 years. And the vast majority of them have made no plans for long-term care. There's an assumption by so many of them, statistically, as much as 85% of people think they're never going to need to worry about long-term care. They're not planning for long-term care. They're not worried about long-term care. But we know that 70% of people age 65 and older will ultimately have to pay for long-term care services. So there's a huge disconnect between the reality and the perception of consumers. And the problem is, because of that disconnect, far too few have adequately planned for long-term care needs. So who's paying for long-term care? Well, the costs of care are very expensive. Home care today in 2022 on average costs $5,000 a month. Moving into an assisted living community, $4,500 a month in rent. That's mostly private pay dollars. And then for skilled nursing, a semi-private room where you're sharing it with somebody else, almost $8,000 a month, and a private room, $9,000 a month. What are the primary funding sources for long-term care? Well, entitlements take a big chunk of the burden. Medicaid covers about 35% of long-term care expenses in this country, and Medicare covers about 25%. But remember, that's just short-term skilled rehab care. Medicare is only going to cover the first 100 days of skilled rehabilitation care. And of those 100 days, only 20 days is 100% covered, and then it's 80%. So a lot of this also ends up falling into private pay. People out of pocket. 33% of people are paying out of pocket for long-term care costs, cash, not to mention what families are doing to just take care of each other, take care of a loved one, the hours and the effort that families put in personally. And 4% of care is covered by long-term care insurance. There's 7.5 million in-force long-term care insurance policies in this country today. By comparison, there's 255 million life insurance policies in force in this country today. I mean, obviously a huge difference. The problem, though, with life insurance policy ownership is the high abandonment rate. Anywhere from 8 to 9 out of 10 life insurance policies that are taken out ultimately are in danger of never paying a death benefit because they'll be lapsed or surrendered. That's a very large abandonment rate when it comes to life insurance policies. Now, seniors in particular are very vulnerable to abandoning their policies in the later stages of their life. On average, 200 billion plus range of death benefit is owned by seniors on an annual basis that is in danger of being lapsed or surrendered, and a large percentage of that could potentially be monetized through a life settlement. So instead of throwing that asset away that seniors have owned and paid premiums on for years, they could be looking at getting its fair market value through a life settlement, using that money for retirement, long-term care costs. But too many will be letting those policies go. Now, the life settlement market is a thriving, growing market. There's no doubt about it. It has become a very mainstream financial option for seniors. People are seeing TV commercials all day long. They've been seeing TV commercials about life settlements now for a number of years, online advertising, reading things in the press that over the years have become very favorable. The life settlement transaction is a mainstream, well-regulated transaction today, compared to where it was, say, 20 years ago when it first emerged and its regulatory framework had not yet been established. So we're looking at an annual life settlement market of about $4.5 billion of life insurance policy death benefits settled on an annual basis. But again, look at the size of the market. 200 billion or more is owned by seniors. 4.5 billion right now is the market size. So a lot of upside, a lot of room for this area still to grow, to help seniors as another tool to pay for long-term care. And that's what we're going to focus on for today's discussion, is the growth, the evolution, and how the long-term care life settlement now plays an important role in funding long-term care in this country. So who's going to qualify for a life settlement and the long-term care life settlement? Well, it's going to be primarily driven by age and health. Remember, life settlements is a unique transaction that will financially reward people with more value, a higher percentage of their death benefit through the life settlement, the older and sicker they are. It's a very unique transaction in that it's going to reward you more the older and sicker that you are. So people typically that are doing life settlements are between the ages of 72 and 95. The typical minimum age is about 65 years old, and health conditions, impairments and chronic conditions, maybe even terminal conditions, usually people with a remaining life expectancy somewhere between 2 and 10 years. That is the range that we would normally see doing a life settlement. Any kind of life insurance policy is going to work, a universal life policy, a term life policy, a whole life policy. And I'd say a minimum death benefit value of $100,000. There can be exceptions, but but the vast majority of cases are going to be a policy that's 100,000 or greater. Universal life and term life, particularly a convertible term life policy, are the most frequently settled types of policies. And people that are in their 70s, 80s, even into their 90s, with measurable health conditions that you can expect a life expectancy range 2 to 10 years. So there are a variety of life settlement options. Life settlements isn't just a one size fits all transactions. It's actually a tool that can be customized to meet the needs of the person who owns the policy and what they're trying to accomplish. Still, the most common type of life settlement is a pure lump sum cash benefit payout. There's also retained death benefit settlements, where instead of cash, or a combination of cash and a reduced paid up policy going forward. So somebody could settle their policy for ongoing death benefit protection, but they wouldn't be paying premiums any longer on that policy. There are people who will do life settlements and then use the money to purchase an annuity to establish a guaranteed income stream for themselves or a loved one. And then there's long-term care life settlements, the use of a life settlement for long-term care that can pay for any kind of senior living, long-term care that somebody would want. So the LTC life settlement itself has been around since 2007. And this has really become a tool that helps people with an immediate need to make payments towards whatever form of senior living and long-term care that they need. So any kind of senior living and long-term care can be covered through an LTC life settlement. You can pay for home care, assisted living, nursing home care, memory care, hospice care, and every care provider in the country will accept payments from an LTC life settlement, particularly when it's used to fund what's known as a long-term care benefit account, the LTC benefit account, which came into the market at the same time as LTC life settlements. So the LTC benefit account, a very interesting financial instrument, great topic to be able to discuss with families who are looking for ways to pay for care. Because what this does is you use the LTC life settlement, the funds from that settlement, to then put money into an irrevocable FDIC insured demand deposit bank account. And think of it, this is like similar to a health savings account. It's not going into any kind of a policy or an annuity. It's going into a bank account like an HSA. Once the money goes into an HSA, that money then sits in the account and it's used for qualified healthcare expenses. Well, it's the same thing with the LTC benefit account. It protects the funds in the account, and then the account is making monthly payments directly to any form of care they want. So the account itself it's a no fee, no cost account. It's also a non-interest bearing account, and it's held by a federally insured bank and trust company. So like HSAs, you don't just walk into any bank and say, hey, I want a HSA. You've got to go to institutions that will provide and offer an HSA. It's the same with the LTC benefit account. There's specific banks that will provide this as a function, and that's something we've worked with now for 15 years. We're very much an innovator in bringing this LTC life settlement and LTC benefit account to the marketplace. So again, not to be confused with any kind of long-term care insurance or annuity. This is nothing that's issued by an insurance company. This is actually, again, a bank account that's then administered on a monthly basis to make payments towards whatever form of care somebody wants at whatever amount they need. And because it's not insurance, there's no wait periods. You're not filing any claims. As soon as money is deposited into the account, it is eligible to start making payments towards whatever form of care somebody needs at whatever amount they need on a monthly basis. And the account's flexible. So the payments can start out at a certain level, and then as needs change, the account can change. So for example, somebody maybe starts out needing just some simple home care assist, and it's $1,000, $2,000 a month. The account's paying for that. But after a while, things get more significant, care needs become more severe, and you got to move into an assisted living community. All of a sudden, that's going to be $5,000 a month. Well, with a simple change notice to the benefit administrator, the account shifts from paying $2,000 a month to a home care provider to $5,000 a month to the assisted living community. And for as long as there's funds in the account, those adjustments can be made because the account understands that nobody's care needs are static. It's a dynamic situation. And as things change, the account needs to be flexible to meet the needs of the person receiving care. Now, the account can also be a tax advantage. The LTC life settlement funds can be tax-free if the policy owner themselves is diagnosed as chronic with 2 ADLs or more, or terminal with 2 years of life expectancy or less. So the account and the LTC life settlement is really designed to benefit somebody with an immediate need for care. This is not something that you would do instead of, say, buying long-term care insurance. In fact, anybody who would qualify for an LTC life settlement would be an automatic decline to purchase long-term care insurance, to purchase life insurance. This is for somebody with an immediate need for care. And because they're 2 ADLs or more, or maybe even dealing with a terminal health condition where they need support and services, that will trigger the tax-free status of the LTC life settlement funds to be used in their account. And if they were to pass away while there was still money left in the account, any remaining balance is going to go to whoever they've named as their account beneficiary, one or more people, and they'll receive that money tax-free as long as they're under the estate tax threshold. So the funds in the account, because they are being used to pay for care, they're in an irrevocable account that's paying directly for care on a monthly basis. It is a Medicaid qualified spend down. The funds were realized by getting the fair market value of the asset and then dedicated into an account to be paid towards care. That is actually the textbook definition of what a Medicaid qualified spend down is. So they're going to be private pay for as long as they have funds in the account and they're using the account. But once they've spent it through, once they've spent down the funds, they can actually make an immediate transition to Medicaid, because every Medicaid department in the country recognizes this as a Medicaid qualified spend down. So let me go through some case studies. I've got 4 case studies here. I'm not going to go into them ad nauseum, but let me give you the highlights on these cases. So in case study A, a family had come to us. Their mother needed to move into an assisted living community. They couldn't afford it, but she had a $100,000 universal life policy. So based on doing a preliminary review, it took within 90 days, the LTC life settlement was completed, and they received $35,000 in total long-term care life settlement benefit amount into their account, set up to then start making $2,000 a month payments to the assisted living community they wanted her to move into. So a combination of $2,000 a month from the LTC benefit account, money coming that she had coming from her Social Security, and other income that she had coming from her retirement was enough to be able to cover I think it was in the neighborhood of $5,000 to $6,000 a month in her assisted living costs, and she was able to move in and afford care without any problems. Here's a second case study B. This was a situation where somebody needed skilled home care services. They were coming out of a skilled rehabilitation stay, were being released into the home, and as part of the whole admission discharge process, it was surfaced that they had a life insurance policy, and they realized that they could potentially qualify to use the long-term care life settlement as the funds they would need to be able to afford the home-based skilled nursing costs, which can be very expensive. They had a $500,000 convertible term life policy, which was able to be settled for $200,000. And based on the care needs, that was $200,000 tax-free money. And they set up a $5,000 a month benefit payment to be able to provide the in-home care that they needed. And their goal to stay at home was realized. In case study C, we had a family that was actually in an assisted living community, but running out of money. And they were actually falling into arrears. They owed money to the assisted living community. The assisted living community warned them if they couldn't settle their account and figure out how they were going to pay going forward, they were going to have to start looking at moving out. And then it was surfaced that they had a $400,000 life insurance policy. They were able to qualify for a $175,000 long-term care benefit. And then they actually took a portion of that money as cash to pay the assisted living community, pay off what they owed in arrears. I think it might have been in the neighborhood of about $20,000. The rest went into their benefit account, and then they set up a $4,000 a month payment from the account going forward to the assisted living community. No worries about evictions, arrears that they owed was paid off, and they were able to stay comfortably in that assisted living community for the next 3 years without any financial worries. Then lastly, this has always been one of our absolutely favorite stories. This was a little bit ago, but it just has always meant so much to us because it was actually a pre-deployment to Afghanistan. A member of our military wanted to get his mother established in an assisted living community before he would leave, but they couldn't figure out how they were going to do it, how they could afford it. But she had a $100,000 life insurance policy, and she qualified for a $39,000 LTC life settlement that went into the benefit account to then set up a $2,100 a month payment to the assisted living community. And again, combined it with some of her Social Security and some savings. He was able to then leave to serve our country in Afghanistan without worrying about his mother, because that money was in the account. It was being paid automatically every month to the community. And he did not have to worry at all about his mother not having enough money and any problems with the assisted living community while he was going to be deployed. And she was able to stay there. And this really worked out well for everybody. So what I want to do is go through an LTC life settlement review before we conclude today's masterclass session with a run through a number of Q&As that are often asked to just make sure we're getting everybody's questions answered, starting with what forms of long-term care will qualify for the long-term care benefit in a LTC life settlement. Well, all forms of care qualify. Any form of senior care, long-term care, even care provided by family members, even improvements made to homes, such as putting in a ramp or safety rails in a bathroom. We've seen families use the funds from their LTC life settlement to set their homes up correctly, to reimburse loved ones who are providing care, who are so often doing that unreimbursed and actually spending money out of their own pockets, moving into assisted living communities, getting expensive memory care, nursing home care, hospice care, anything that is related to a long-term care support or service will be covered. Is the benefit account like long-term care insurance? We get this question so much. And again, I just want to be very clear. This is not an insurance policy. This is not doing a life settlement to buy a long-term care insurance policy. You're actually settling the policy to establish a bank benefit account like an HSA that will then be making monthly payments to any form of care somebody wants. Now, there's a lot of flexibility with that. Somebody can take some of their LTC settlement in cash, put some into the benefit account. We've seen families mix it up where they've done that, and they've also even put money into an annuity. So there's a lot of flexibility for it. But the LTC benefit account itself is a safe vehicle to protect money, administer it to pay for care, and for a person with an immediate need for care, that's all tax-free dollars. Are there any fees or premiums related to the benefit account? Well, no. There's absolutely no fees associated with the LTC life settlement. There are no fees related to the long-term care benefit account itself Once the settlement of the policy is complete, the policy owner is no longer responsible for making any premium payments. So this is actually a free transaction. There's no fees associated with the settlement. There's no fees associated with their account, and there's no premiums going forward. What happens if the enrollee dies before all of the funds are paid out? Every account has account beneficiaries named to it, which can be one or more people. So if there's any account balance left when somebody passes away, those account beneficiaries are going to receive the remaining balance. And I can tell you, we've seen some significant balances that have been left over, tens of thousands, sometimes even six-figure amounts in the account, that once the person has passed away and they've received private pay care in the manner that they wanted, there's still been money left from that policy settlement to go to the family tax-free, as long as they're below the estate tax threshold. So is the enrollee exchanging the ownership of the life insurance policy? Yes. And I guess you could say that's the cost of doing this, right? The original owner of the policy and their beneficiaries are not going to receive the ultimate death benefit. They have sold off the policy today for its fair market value to then use those funds to meet their current immediate needs. And therefore they have sold off the policy. They're no longer the owner of the policy. They're no longer going to receive a death benefit. But again, they've been released from any premium responsibilities. And the policy now is no longer considered an asset counting against them for any future Medicaid eligibility. Remember, this is considered a Medicaid qualified spend down. So how is the long-term care benefit account regulated? It's actually regulated in more than one way. First, the LTC life settlement conforms to the state level regulations that govern life settlements. Then, because you've obtained the fair market value of the policy and put it into the account, you're now complying with Medicaid rules on how a spend down needs to be conducted. And this is ultimately being put into an FDIC insured bank account, which is regulated under federal banking regulations. So you actually have 3 levels of consumer protection and guidelines that are in place when somebody uses the LTC life settlement and the LTC benefit account. How is the LTC benefit account itself safeguarded? Well, the money is going into an irrevocable FDIC insured account. This is with a nationally chartered bank and trust company regulated by federal banking regulations. There's no fees for the account. Again, it's a non-interest, non-fee account. And any money left in the account is going to go to loved ones. It's not a use it or lose it. It's a use it until you either have spent it all down, or if there's anything left over, it can still benefit family members. Is the long-term care benefit account something that's available to you today? Yes, absolutely. It's been actually actively used across all 50 states for the last 15 years. It first came into the market in 2007. We were very much a pioneer of creating and bringing this into the market. We've been actively out there working with care providers across the country, families, advisors, whether it's insurance advisors, financial advisors, lawyers, accountants, have been using this for years for every form of senior care that exists. And literally millions of dollars in care has been paid for through the use of long-term care life settlements, again, going back now 15 years. Is there political support for this approach to funding long-term care? And the answer is a resounding yes. Now, going back for some time, we've seen the National Conference of Insurance Legislators, NCOIL, through one of their model acts, a Consumer Disclosure Protection Model Act, endorse the sale of a life insurance policy, and then using that money to obtain a long-term care benefit plan. This long-term care benefit plan, this was endorsed by them years ago. Then the National Association of Insurance Commissioners, NAIC, also in a paper that they released back in 2017, which I'd be happy to share with anybody, talked about the use of life settlements as a tool, an innovative tool in the marketplace to help people pay for long-term care, and specifically cited the use of putting those funds into an LTC benefit account as a way to protect money and get consumers the highest value for their life insurance policy, and then use it towards their long-term care needs. And then it's about 2 years ago now, there's been a bill that's been pending in Congress. It's a bipartisan piece of legislation. It was introduced through the House Ways and Means Committee to create a senior health planning account known as a SHIPA, which is based on this account. The long-term care benefit account, the LTC life settlement, is the blueprint, which they've used to say we should maybe have an official long-term care HSA designation in the tax code, exclusively funded by a life settlement, that if anybody did a life settlement, regardless of their health diagnosis, whether they had an immediate need for care or not, if they put the money into the account, it would all be tax-free on day one. Today, to get the tax-free treatment, you have to have an immediate need for care, 2 ADLs or more, or 2 years of life expectancy remaining or less. But if this act in Congress passes, then it's just put the money in the account, regardless of your health condition, regardless of your basis in the policy, regardless of anything, and it would all be tax-free money. So remember, the LTC life settlement and the long-term care benefit account has been around now for quite some time. This has become a very mainstream and well-known option, particularly in long-term care circles, for consumers going back 15 years. It's designed to be a protected private pay vehicle for people who wish to use the life settlement value of their life insurance policy towards their care needs. This gives people an option to get the value from their asset instead of abandoning it. And we have far too many people to this day, regardless of how many people are seeing TV commercials or are becoming more and more aware of life settlements, there's still a way too high abandonment rate on life insurance policies for people who have paid premiums for years. I mean, think about it. A life insurance policy and a home are recognized on the same footing as an asset. You would never just abandon your home after years of mortgage payments. Everybody sells their home when they leave it. Yet people make premium payments for years on life insurance policies, and they'll easily just abandon that, walk away without realizing they may have thrown away tens to hundreds of thousands of dollars, and maybe that was tax-free money. So the owner of a life insurance policy should never allow their policy to lapse or be surrendered without first determining if they could qualify for a life settlement. So I want you all to remember the LTC life settlement is a very viable option to consider for policy owners as a way to help them fund long-term care needs at the time care is needed. If you didn't adequately prepare for care, and you know, you're one of the people who own one of the 255 million life insurance policies in this country, but maybe you're not one of the people who own the 7.5 million long-term care insurance policies in this country, or maybe you own both, a long-term care insurance policy and a life insurance policy. Either way, getting the full true value of that life insurance policy asset in a way that is optimally designed to be tax effective and establish a protected vehicle to pay for care on a monthly basis should never be overlooked when it comes to life insurance policy owners. So I want to thank you for spending time with us on today's webinar, and would invite you to get your free copy of our Retirement Genius Tip Sheet, LTC Life Settlements, by calling 888-627-3735. We'd love to give you a white paper tip sheet about the LTC life settlement, kind of wrapping up a lot of what we've covered today, so you have it in hand. And for those of you that joined us on today's webinar, we'll be making sure that we get you a copy of the tip sheet and the recording of this webinar as well. But call 888-627-3735 to order yours so we can get it to you as soon as possible. And then I invite you also visit our website, retirementgenius.com. And then for advisors, specifically advisors.retirementgenius.com. For more information, we'd love to be working with you. We'd love to look at any policies that you may have that could be a candidate to use the LTC life settlement. And I always like to remind people to also visit our podcast, Retirement Genius, the podcast, wherever you get your podcast. You'll find us on Spotify, Apple, Google. We are a Forbes podcast with Retirement Genius. Just look up Retirement Genius and start following our podcast today.